welcome and introduce myself. I'm Linda Halloran and want to welcome you to Town and Country's 7th annual Money Conference. And for the second year in a row, we are hosting this event virtually. We're really glad that you're with us tonight. We know that this past year has brought a lot of financial challenges to many people. And here at Town and Country, your financial wellness is very important to us. We know that each member's financial story is different, and we are committed to helping you reach your financial goals and financial wellness in many different ways, whether it's working one-on-one with our staff, presenting workshops and conferences like this, offering personal financial tips and information through blogs, social media, or providing apps and budgeting tools to help you manage your money. We are here to try and help you get to where you want to go. While the pandemic has been financially stressful for many people, women in particular have felt much of the financial impact. For many women, the role of caretaker has taken on new meaning. Others have had to step away from the workforce due to family responsibilities or layoffs. And others have shifted to a remote work mode while juggling homeschooling with their children at the same time. That's why, and those are some of the reasons, that this year we've decided to focus on women and money with our money conference. And we are pleased to have invited and partnered with personal finance expert Jean Chatzky to be with us tonight and talk about some of the unique challenges and opportunities women face today when it comes to their money. Jean knows a lot about women and money. She is the CEO and co-founder of Her Money. And in addition to the Her Money website and information resources, she is host of the weekly podcast of that name, Her Money. She's been a financial editor for the Today Show for over 25 years and has also worked as a financial ambassador with AARP, also appearing on a number of news programs, CNN, MSNBC, The Oprah Winfrey Show, and others. She's also a best-selling author, authoring many books, 11 books, in fact. Her latest is on Women and Money, the judgment-free guide to creating the joyful, less stressed, purposeful, and yes, rich life you deserve. So we're going to hear from Jean in just a couple of minutes, but I'd like to mention before we get there that if you'd like to continue the conversation about women and money after tonight, I want to let you know that Town and Country is hosting an informal virtual happy hour on Wednesday, May 26th from 7 to 8. That's going to be led by Jean, which will be an informal conversation about a lot of different questions that women have about their money. So you can register for the event at tcfcu.com, and I'll also post a link this evening in the chat. Also, too, we have plenty of time for questions following Jean's remarks. So you can reach out to us with your questions two ways. Both are in the chat, but if you have a specific question, put it in the chat, write it into the chat to everyone, and we'll get to that at the end. Or if you'd like to ask a question personally yourself, just put in a note that you have a question, and then we will turn on your audio so you can ask your question yourself. So without any further hesitation, I'd like to introduce you and welcome Jean Chatzky. Hi, Jean.
Hey, Linda. Thank you so much for such a nice introduction. It's my pleasure to be here with all of you. I've so loved coming to Portland in person to be with you in prior years, and I hope that we get to do that again in person sometime soon. But for now, we've gotten really good at these remote webinars, and I just want to echo what Linda said before I dive in. We've left time for questions on purpose at the end. I know you have questions because you've been sending them in to Linda, but it's really fun if you feel like asking them yourself. So just in the chat say, hey, I've got a question. We'll unmute you, and then you and I can actually have a little bit of a conversation, which makes this lots of fun, very interactive, and I think adds to the whole experience for everyone. Okay, so let's dive in. I'm going to start by asking you a question that I'd like you all to think about. And the question is this: what do you want from your money? What do you really want from your money? And while you're thinking about it, I am going to tell you a short story. So about a decade ago, I wrote a best-selling personal finance book called Make Money, Not Excuses. You can tell it's for women because it's pink, like all the other personal finance books for women at that point in time. And it was aimed at convincing women like us that it was time to step up and take control of our finances. And we needed to do this because, at least for the foreseeable future, we were going to continue to under-earn men. We were going to take breaks from the workforce to care for kids and care for older parents. And those things combined would put us behind when it came time to saving for retirement. And then we were going to go on to outlive our spouses by an average 7 years. What all of those factors meant when you put them together was that 90% of us, 90% of women would at some point be responsible for handling our personal finances personally. There was no getting around that. And there was also no getting around the fact that we were all better off knowing how to manage our money before we headed into a crisis, rather than having to learn it while we were under stress and on the fly. But things have really changed, and not just a little bit. Today, although we have yet to close the salary gap for good, and we will talk about that in just a moment, women do have more money. About 38% of us have already become the higher earning primary breadwinner for our families. And that's not the only demographic change that's going on. More than 50% of women are single. Many are single by choice. Many will stay that way, making them the de facto heads of households for their families. When you add them in to the primary breadwinner number, that primary breadwinner number soars to 60%. Almost half the millionaires in this country are already women, and there is no stopping this train. For every 100 men who graduated from college last year, 132 women graduated. Those college degrees are going to drive increased earnings and increased power for women. Women are also poised to inherit about 70% of the $41 trillion in intergenerational wealth that's expected to pass hands between the generations over the next couple of decades. And it's not that our parents prefer us to our brothers, by the way, although I do like to remind my brothers that my parents certainly do. It's that women are going to inherit twice. We're going to inherit both from those parents, but we're also going to inherit from those husbands that we'll outlive. Add all of it up, and what you get is the fact that by the year 2028, women are expected to control 78% of the discretionary spending around the globe. And by the year 2030, 66% of America's wealth. What has changed even more dramatically, though, is the answer to the question that I asked you. What do we want to do with our money? What do we want our money to do for us? First and foremost, for women, the life that we want to create is the target. The money is just the tool that helps us achieve it. And for many men, it's the other way around. And there are a lot of other big differences as well. Women, studies show, are more concerned than men about both economic issues and political issues, and we're more willing to throw money at those issues in order to create the change that we want to see. We're more concerned than men about the financial situations, the financial stability of our kids and our grandkids, and especially about making sure that a college education is in the cards for them. We're more concerned about leaving a legacy for our families and our communities and the world. We're more concerned about using our money to help others. And we're more concerned, and with very good reason, and we will talk more about this, about making sure that we don't outlive our money. And that is why to take all of this additional wealth and just plop it into the financial playbook that men have used for decades, it doesn't work. It doesn't work because we're different. And this is something I know because pre-pandemic, I spent 2 years, 2 solid years doing research for a new book, this book, Women with Money. I started by talking to hundreds of women in big groups and small groups as individuals, and just asking that question over and over and over again. Take a look at how it went.
They really want to just be able to stop working at some point.
Time, and also the luxury to do what I want with that time.
Safety and security.
The safety and security thing, especially going through divorce, really got to me.
You want to be able to pivot if there's an emergency.
Putting food on the table, health insurance. You really can't enjoy anything else unless you feel that you can provide for yourself and your family.
If you have enough money to be safe and secure, that allows you to have happiness.
Because it allows me to live the life that I want to live. I don't think that women of today can sit back and sort of be the princess, because there aren't as many knights.
Interesting, right? It's interesting. And once I got answers, I dug in deep with psychologists and behaviorists and financial planners, economists, and other experts to formulate a plan to make it all possible. So today we're going to start where I began so that you can begin the process of assessing the possibilities in your own life. Interestingly, one of the very first things that I learned was that I was asking the slightly wrong question. In 1943, a very now famous psychologist named Abraham Maslow wrote a paper entitled A Theory of Human Motivation. And this paper included the world's first look at this pyramid-shaped hierarchy of needs. Essentially, and many of you, if you took this a class in psychology or sociology in college, you know this, Maslow argued that we have to satisfy the needs at the bottom of the pyramid first, the ones that are tied to our survival, like the need for food and water and warmth, before we can move to the upper levels of the pyramid where we can focus on things like fulfilling love relationships and doing work that makes us feel valued and accomplished and achieving our full potential. And this theory, despite the fact that it is now 70 years old, really hasn't gotten old at all, because what I discovered was that before women can move on to the things we want, we have to cross off our list those things that we need. And what we need, it turns out, is safety. You heard it in that tape. We need safety. We need security. We need stability. Time and time again, the women that I spoke to described this need, not just for a home, but for a home with a paid off mortgage. And not just for a car, but for a safe car with every possible safety feature and all of the assorted airbags and backup cameras, and not just for savings, but for actual money, actual cash in the bank. And what I realized in listening to all of these women describe a need for the very same thing was that despite being a financial expert, I'm actually very, very typical. After I got divorced close to 15 years ago now, when it became clear that I was going to be the one to move, I was laser focused on buying a house. And never mind that it was 2005 and real estate values were just soaring, very much like they are today. I wouldn't hear of renting, because to me that didn't feel as safe. That didn't feel as secure. I also seriously curbed my spending at the time and ramped up my savings, because being able to see a climbing balance every time I signed onto my accounts online made me feel more stable in a way that adding additional pieces to my wardrobe or purchases never could. And when I opened my garage door in the morning, there still sits a Volvo wagon. And nothing says safety and security quite like a Volvo, unless it's a Volvo wagon. And what I've come to understand is that this longing for safety and security, it is incredibly understandable. For women, feeling safe in our finances is not something that we can take for granted. After a divorce, it's 1 in 5 women who falls into poverty. After retirement, women believe that their money will run out 5 years too soon. Men, on the other hand, are pretty convinced that theirs will go the distance. And since the pandemic, these trends have just been exacerbated, and with very good reason. You've probably heard that economists are calling this a she session. When you look at the work sectors that were crippled early on, service jobs, retail, personal care, food service, not to mention small businesses, they are the ones that are disproportionately dominated by women. You combine that with the added childcare responsibilities that have arisen as children were home from school, and it has been a 1-2 punch to women. This is why more than half of women are having trouble sleeping. More than a quarter of women are feeling the physical symptoms of severe anxiety. And so if you're feeling this, you are not alone. And yet we can't let these feelings stand in the way of making the right decisions, the right financial decisions during these times. We can't let this fear paralyze us into clinging to safety, because there is a very big problem with that need for safety. Ironically, it stands in the way of our financial security. Let's go back for a second to that cash in the bank. According to research from BlackRock, women keep about 71% of our assets in cash. Men keep about 60%. Now, on average, that money is earning about 0.1% in interest. It's definitely getting a little more with the credit union, but right now, as all of you know, interest rates are incredibly low. And what that means is that at average interest rates, you put $1,000 on deposit, it's going to earn you about $1 a year. And after 10 years, $10. Compare that to what happens if you actually invest the money. Over the past 10 years, $1,000 in a balanced mutual fund, a mutual fund that invests its assets with a basic 60% in stocks, 40% in bonds mix, would earn an average 11%. that $1,000 would grow to nearly $3,000. And if we added to that balance every single time we got paid, that's not just how we stay ahead of taxes and inflation. That is how we build long-lasting wealth. But before we can get there, we have to understand a little bit about ourselves, not just as human beings, but as financial ones. And at the risk of putting you all on the couch, that means going back to your childhood. How you feel about money today is directly related to the feelings about money that you absorbed in the home where you grew up. It's not what you were taught. I mean, I give your parents a lot of credit if they tried to teach you about money, if they put jars on your dresser for saving and spending and giving. But that's not what this is. What you absorbed about money truly shaped you. It's what you felt. It's what you heard. It's what was in the atmosphere. It's the fact that there was tension every single time the credit card bill arrived, or that there was stress rather than joy around the holidays. In reporting this book, I held a series of what we call Her Money Happy Hours. And that was actually what you saw on the tape earlier. It's what we're going to have in a live format later this month. We developed a deck of cards with leading questions about money. And we just go around the room, or around the Zoom, as it happens to be. We draw cards and we start talking. We also all bring a glass of wine, because when you're talking about money, there is no doubt that that absolutely helps. And women love it. And I hope that you'll join us for that interactive event. But I loved it too, not just because I got to hear from all these women, but because these Her Money Happy Hours gave me an access to a huge array of money stories. This is Alyssa's. Alyssa said, "My dad is a financial planner. That's his job. But he raised us with values of poverty. Whenever we were going to go play a game of Ms. Pac-Man, he'd say, 'Might as well just throw that money in a ditch.' I thought we were on the verge of food stamps." Well, one night we went to the Dairy Queen, and everyone kept coming up to him and talking to him, and it turned out he owned the Dairy Queen. We spent the weekend going to garage sales. I had no idea. And so now, even though we're doing just fine, I always feel broke. That's a money story. That experience shaped who she is with money to this day. Here's one more. This is Virginia's. Virginia said, "When I was 9, we moved to a pretty ritzy suburb. In my old neighborhood, everyone was middle class or working class. When we moved, the kids had different brands of things. I had the wrong sneakers. I had the wrong backpack. It took me a while before I understood what I was really supposed to want. I think that middle school stuff gave me a template for my feelings today. If I have a big work meeting, I'm going to go out and buy something new, probably. There is a sense of wanting to feel that I can throw money at a problem and solve it that way." Nobody taught these things to Alyssa or Virginia. They were in the atmosphere. They were in the ether. To figure out what's your money story, you need to ask yourself some pretty pointed questions. What was the feeling about money like in the home where you grew up? What was your earliest money memory? What messages about money did your parents pass down? Do you remember your parents fighting about money or tension in the air? The other way to get a grip on who you are in relation to money is to use my shortcut. At my website, hermoney.com, and some of you may have done this already, we have something called a money type personality test. It was developed in tandem with a psychologist at Stanford University. And there's just a clickable banner at the top of the page where you can answer some questions and you can get some very quick answers. What you'll learn is that your money type is combined of 5 different personality attributes. You're never just one thing, you're a combination. It's kind of like that Pixar movie Inside Out, but it's important to know which one of your money personalities is driving the bus. I'm going to describe them for you because you may see yourself in them as well. You may learn, for example, that you're a connoisseur. Connoisseurs love money, and there is no judgment. But there, by the way, there is nothing wrong with that. They love spending both on experiences and on things. And if you see yourself in this, it's very important for you to succeed to start automating, to move money into savings and investments automatically. Otherwise, the money's just going to flow right through your fingers. Maybe you'll learn that you're an independent. Independents value freedom, they value autonomy, they value living life on their own terms, and sometimes they brush off thinking about money. They don't really want to play by the rules. If you think you're an independent, it often helps to line up both your spending and your investing with the things that you truly value. And in a few minutes, I will share a hack for how to do that. You may learn that you are a producer. Producers are grounded, they're diligent, they're consistent, they like accumulating money and watching it grow. I'm a producer, that's my primary money type, although I definitely have some connoisseur in me as well. And what we learned about producers is that producers can be conservative. They can sometimes be too conservative, regardless of how much money they have. Producers have to push yourself to take enough risks with your investments. And if you're a producer like I am, you may find that managed solutions in your 401k or target date funds that keep you on track are good solutions for you. You may learn that you're a nurturer. Nurturers believe that money is just a tool to help others. And those others may be their partners, it may be their children, their families, their coworkers, their communities. They're at risk of giving away too much, even giving away too much to charity. And so for nurturers, it's very important to have accountability, to have somebody there, whether it is a partner or a friend or a money buddy or a financial advisor, to keep them on track. And finally, the last money type are the visionaries. Visionaries see money as a tool for self-expression. Visionaries are all about following their passions. They are often satisfied with having enough if they feel that they are able to do creative work in the world, and they're at risk of plowing way too much money into their businesses, particularly if they're entrepreneurs who've started their own businesses. The key to success for visionaries is saving enough for you rather than putting it all into your business. Once you know your money type, and again, I encourage you to all go ahead and learn it. It's a fun tool and it's a free and fun exercise. You're one step closer to being able to deal with your money in a way that actually works for you. And then you can start asserting more control over your money in order to accomplish your larger goals. And that means investing. When I am with a large group of women in person, I'll often ask the question, how many of you would call yourself investors? I see a question popping up. The assessment tool is at hermoney.com for the person who's asking. I'll ask the question, how many of you will call yourself investors? And at that point, about a third of the hands in the room go up. Then I'll ask the question, all right, so how many of you have an IRA or a 401k? And almost every hand flies in the air. And there's a big disconnect here. We are all investors. We just don't feel like it. A woman at one of my happy hours in San Francisco, she put her finger on why. She said, I don't manage my money each day. I just put it in. I look at the statements and I hope that it's going to get the average that you're supposed to get. But to me, that's not an investor. An investor is someone who takes time during the day to look at stocks and see how they're doing and maybe trying to time the market. And I looked at her and I said, that would make you a bad investor. What this woman described, what the description of the person on this screen, that is a trader. Traders buy and sell much more frequently. They try to make money by betting on falling markets as well as they do on rising ones. Investing is different. Investing is slower. It's more long-term. It's a process where patience is rewarded rather than punished. It's a world in which everyone can get a trophy. There are three things that determine how successful most investors are. The first, and by far the most important, is the amount that you save. Socking away 15% of whatever it is you earn, including matching dollars from your employer, will generally be enough to know that you can retire at age 65 and with Social Security have enough to replace about 80 to 85% of your pre-retirement income. But just like you can't out-exercise a bad diet, you can't out-invest your way of a savings shortfall. You have to save enough to build a base that you can then invest to grow. The second factor, and it's also hugely important, is your asset allocation. And your asset allocation is your mix of stocks and bonds and cash that you choose to balance risk and reward. And years and years and years of research have shown that asset allocation in and of itself is responsible for the return of about 90% on your money. Finally, third on the list is security selection. That's the particular stocks and bonds that you put into these baskets. That's not important at all, and these charts show you why. The S&P 500 has gone up about 10% a year since its inception. The Dow has gone up just a little bit less than that since its inception. If you decide that you're okay with those returns, and for the record, I am just fine with those returns, then all you have to do to be a successful investor is to buy the market. You put your money into low cost, highly diversified index funds or ETFs that mirror the market in a proportion that makes sense for your age and your risk tolerance, or you put it in a target date fund and then you can just call it a day. And it not only works, it explains why research shows that women are actually better investors than men. Men trade about 35% more frequently than women do. They dip in and out of stocks and it costs them. Women don't. We save about 0.4% more than men save annually. We earn about 0.4% more than men earn annually. And in part, we do it because we're not doing all that trading. We're not spending money on commissions and fees. Those small wins, even though they look minuscule, can easily add an additional $250,000 to your portfolio over the course of a career. It is imperative that we invest, and it's imperative that we invest habitually. Why? Because even before the pandemic, the salary gap wasn't closing fast enough. At the current pace of change, women won't reach salary parity with men until the year 2119. But what we can do is speed up our own individual clocks. And we do that by starting to ask for more money for us. We know that 57% of men negotiate for their first job out of college. Only 7% of women do. And every additional negotiation starts where the last one left off. Here's the thing about getting paid. It is good. Getting paid is good. Getting paid more is better. Not earning up to your potential, it isn't good for anyone. It isn't good for you or your family or your kids or the younger women in your network who are watching your every move, or frankly for society as a whole, because research has shown that women who do earn more are more likely to learn about our finances, take control of them, and be confident about the actions that we do take. And whether that extra money shows up in our brokerage accounts or our savings accounts, what it manifests are the other things that women want from our money. And I just want to show you what they are because they're so hopeful and optimistic. Once we've gotten past safety and security, once we've gotten past asking for more and investing for tomorrow, here's what women want. Women want to buy homes. We want to buy them whether or not we have a partner to share them with. We want to buy them for investments as well as our primary residences. Today, single women with kids and without kids account for twice as many home purchases as single men. We want to launch businesses. There we go. We want to launch businesses. Pre-pandemic, 900 women were hanging out a shingle every single day in the United States. And as we have started to return to normal, that number has rebounded. The rate at which women launch businesses is 1.5 times the rate of men. We want to help our kids not only launch, but flourish. And although I wish I didn't have to say this anymore, it is really important to be cognizant that we're giving our daughters the same financial lessons that we're giving our sons. According to some recent research, as recently as 2018, more parents were still talking about financial goals with their sons than with their daughters. More sons had credit cards. More sons were aware that their parents were saving for college for them. If we expect our daughters to be less capable than our sons, they will be. We want to be able to support our parents if and when they need it without sabotaging our own financial futures. And as our parents age, it's become clear to me that this may in fact be the toughest hurdle to jump, because we can take loans for college, we can put off our own retirements by a year or two, but if our parents need financial support, most of us just give it, which is why it's so important to try to eliminate those sorts of surprises in your future. Talk with your older parents about how they're situated for tomorrow and if and when you may need to step in and help. We want to leave a mark on the communities and the causes and the people that we care about. And I know that I am preaching to the choir here. And finally, sometimes what we want is nice stuff. And there is absolutely nothing wrong with nice stuff. Anna, who is a lawyer in Philadelphia, she drew a card at one of my happy hours that read, "I spend money because." And she thought for a moment and she read the room. And then she said, "I spend money because I can." And it feels effing awesome. Anna had been through a really, really tough divorce. Her ex-husband had racked up 6 figures in credit card debt, half of which was hers to repay when they split. She had fought her way back. And now when she spends with joy. In my house, we say, this is why we work. I say it to justify paying way too much for theater tickets, which I got to tell you, I cannot wait to do again. I say it when I'm getting my hair blown out, even though I have absolutely nowhere to go. There can be this weird morality around spending. Sometimes we look at other people's purchases or what they're choosing to do with their money, and we decide it's appropriate to judge them. Well, no, not here, not on my podcast, not on the Her Money website, not in the Her Money happy hour that we will be holding together. At Her Money, we know that we will be happiest if we spend in a way that lines up with our values. And if you're not sure that you're doing that now, the quick way to figure it out is to just track your spending for about a month and then go back and look at all of those line items. The ones that you say that you would absolutely make again, those are the ones that you value. Those are the answers that will become very clear. I am, for the record, a living example that we can do all of these things. But I know that we will do it a lot faster. We will do it a lot easier if we do it together. So I want to invite you to join me, become part of our Her Money community, listen to the podcast, participate in our private Facebook group, as I know Linda does, as we lift each other up and cheer each other on and stand in each other's corners, as we answer each other's questions and quell each other's fears. We clear the way, not just for ourselves, but for the next generation of women with money. And this, I believe, is how revolutions begin. So thank you so much for listening to me. I am happy to answer any questions, and I will turn it back to Linda to facilitate that.
Thanks, Jean. That was lots to think about. That is for sure. And I am an advocate of your Her Money podcast. I look forward to every Wednesday to hear who the new person is with something that gives me a lot to think about relative to where I am in life or people I know and things that I can share to help other women along the way. So I always enjoy that. So I'm going to give you folks out there a chance to post a question or to pop your name in the chat to let us know that you do have a question that you'd like to ask Jean.
Jody said she has a question, I saw.
I have a creative brain and I have a creative business, and money comes in big waves and it's not predictable, and I don't have a boss and I make plenty, or at least enough money. I'm right now under contract for a camp on the ocean, and my husband's panicked because we kind of can't afford it, but the money all sort of works if we rent it out, blah, blah, blah. But nothing is conventional about my money, and I'm a disaster with Quicken and QuickBooks and all my accounts, and I desperately want to get it organized, because the more organized I am with it, the more I feel like I'm saving. But the more out of control it is, it just feels like thousands are here and then they're gone, and I can't keep track, and I just need help. And I'm wondering, I've tried hiring people to do it, but I don't even know what kind of person to hire to manage the situation.
So two things. The first is, I think what you need to do is to level your money. And this is not exactly the question you asked, but I will answer the question you asked. When your income is irregular, and so many people these days have incomes that are irregular because we all have gigs and then side gigs, or a job and then a side gig. It's really, really helpful to look back over 6 months to 12 months of income, figure out what the average is, and then live on the average. So when you have a surplus, that surplus sits in a separate account and you move it into a spending account regularly. That way you won't typically get ahead of yourself. But the person that you are looking for is called a daily money manager. They are not, yes, they're not financial planners, and they're not even financial coaches. They are very specifically daily money managers. There is an association of daily money managers, and they have a zip code locator where you can just type it in and you can find somebody. And often these people work with, sometimes they work with older people. Like if you have an older parent and you're trying to handle their bill paying and things like that, daily money managers can be very helpful with that as well. But that's where I would suggest that you would start. And for the chaos, if you're willing to make an investment, I would also suggest we've got an 8-week program at Her Money called Finance Fix. It's work, but it will help you get a handle on the chaos and get that tracking going so that you know exactly what you've got and where it is.
Thank you.
Sure.
We also have a question that Sloan Goodall would like to ask.
I'm asking this question for my daughter, who is in her late 20s, almost 30, because as you were saying about how your parents raised you, my parents were poor, but if we ever ran into money, instead of paying, behind property taxes, they'd say, "Come on, kids, let's jump in the car. We're going to Storytown." So they were literally live day by day. So I'm widowed as well. I lost my husband a few years ago. We didn't prepare well. I work at the credit union, which I love. But I'm asking for my daughter because I almost feel like it's too late for me. Jean, I'm 58, so we're right there. So she's trying to save in her savings account and actually have a savings, which I never really taught her, even though I'm a banker. And where would she go besides her savings that's safe and that's going to make more money than a savings, that doesn't cost a lot? I know there's all kinds of online things to do.
Yeah. Does she have a job that has a retirement account?
Yeah, she's actually in a Medicare startup company. And they aren't matching yet because they're just starting up.
That's okay.
But
I mean, it's always better.
401k.
It's better if they match, but if not, she should, I would say the first thing she wants to do is just make sure she has at least a couple $1,000s put away for emergencies.
Yeah, she does
but then
that.
she should fund a Roth IRA. And she can do this at any brokerage firm, any robo-advisor. The fees are negligible. It won't cost a lot.
Okay.
There is risk, but she's young, and this is when she should be taking risk. So she should buy a very, very broad portfolio of index funds or ETFs, inexpensive investments, and she should just make sure that every time she gets paid, money comes out and either goes into the 401k or goes into this Roth IRA. And particularly for younger people, I know we had a question come in earlier before the event about, who's right for a Roth and who should have a more traditional IRA. The younger you are, the more a Roth makes sense. Although I do have to say that I think a Roth makes sense pretty much across the board.
So you think she should do Roth and 401k?
If she's making enough money to do both.
Or does the 401k let you do a Roth? I don't think
it may.
Do they?
It may. The 401k.
I'll have her look into that.
Yeah, the 401k may have a Roth option. If it doesn't, I would probably just do the Roth first.
Okay. You have been wonderful. Thank you so much.
Sure. Thanks, Sloan. Jean, there's also a question from a Debbie Bartlett, and she wrote, where would someone start investing besides savings accounts? Kind of like just the sequence of the process.
Yeah, there is a sequence. And so first we save for emergencies. Then we put our money into vehicles where we maximize our tax advantages. So 401ks, particularly if they have matching dollars, or 403bs or 457, any retirement account with a match comes next. After that, you put your money into tax advantaged vehicles that don't have a match. So that would be IRAs, Roth IRAs, health savings accounts, which can be supplemental retirement accounts depending on how you use them, 529 college savings accounts. And then after that, if you can still save more, you just put your money into a brokerage account and you invest for your future in a way that makes sense for your age and for your risk tolerance. The other place it's important to put our money as we look to where that next dollar goes is toward debt repayment. And so generally, when we invest a dollar, we look to the return that we get on that dollar. And if you're using your money to pay off high interest rate debt, then you're getting a return, any debt, by the way, the return on your money is equal to that interest rate. But if you're paying off a credit card bill at 19.9%, that's a really high return on your money, and it's guaranteed. So you slot that in right after the 401k match.
Awesome. Thank you. Karen St. Clair has a question.
Yes, thank you, Jean. This has been fantastic. I have a question on percentages of investment of your annual income. What are the percentages that you recommend for investing and also for cash contributions, charitable contributions?
Boy, charitable contributions really, that's your call. On average, Americans tend to give away about 2%, but I know people who tithe, and that's 10%. It's such a personal decision. But in terms of the money that you're putting away for your long-term future, you want to be saving 15% at least. And again, that can include matching dollars. But if you don't receive matching dollars, you got to figure out a way to try to get to that 15% yourself. And the reason that the 15% is at 15, whereas I'm sure some of you heard in the past people say 10%, is just because we're living longer. And we're living so much longer that it's really important that you accumulate enough money so that you have enough to go the distance.
Thank you.
Lori Littlefield also has a question. Hi, Lori.
All right.
Yes, we can hear you. Hi.
All right. So I am 57. I just purchased a camp all by myself. Yay, that's my legacy for my grandchildren. I have been putting aside 15%, but the pandemic has taught me I'm not honestly going to retire. I would go crazy. So I'm looking more like for a semi-retirement. I have a little bit in Roth. I have a little bit in a 403. And is it too late?
No, it's definitely not too late. And there are a lot of levers that we can pull here. When we look at our retirements, the numbers that I throw out, the 15%, the replacing the 80 to 85% of your pre-retirement income, that's an average, right, of what we see people needing to spend when they're in retirement. But working even a few years longer really helps, because then the money in your retirement has additional years to grow. You are not claiming Social Security early, and that's a very, very big deal. Most people in this country still claim Social Security at age 62, but for every year you wait between 62 and 70, you get an 8% bump in your benefits. And that is really tough to beat in any other way. So, and then there's your cost of living. And that's within your control to some degree. If you are living in a smaller rather than larger place, if you choose to downsize, if your hobbies and your travels are a little more low key, those are all choices that we make. And so the thing to try to figure out for yourself is how much your retirement is going to cost you based on how you want to live and when you actually want to do it. And the only cautionary note that I would throw out there, because I'm like you, Lori, like I do not want to retire. I think I would just go nuts. But I've watched as many people have been retired, it's not their choice. And it's not just the job, it's often a health issue. And so you got to be careful to try to strike some sort of a balance there.
Thank you.
Sure.
Jean, you okay to keep going for a little bit?
Sure.
Okay. Lisa has a question.
So my question is pretty much along the thing we're talking about. So I was laid off my job last month, and it was the only 403B I had in terms of retirement. So my question is, how do I determine whether I just leave that fund alone and don't touch it, or roll it over to a Roth or an IRA? How do you make that decision?
So you can't roll from a 403B directly to a Roth. You could roll it into a traditional IRA. And at that point, if you wanted to down the road convert it to a Roth, you could look at making that decision, but you would have to pay the taxes on that money. As far as whether or not to keep it where it is or to roll it over, you should look at the costs of maintaining the account with your current with your former employer. Sometimes they are incredibly reasonable. Sometimes they're more expensive than you think, but you just don't notice them while you're still working for that employer. So take a look at the costs compared to the costs of an IRA. And then take a look at the choices that you have in your investments. One of the benefits to rolling into an IRA is that the world opens up in terms of your investment options. And so if you are currently offered a more limited menu of choices, rolling over is probably the right thing to do.
Okay. And what about the tax implications? How does that work?
As long as you directly roll over, you won't have to pay taxes. You should not take ownership of the money yourself. So if you're going to roll over, whatever firm you choose to roll to, have them execute the rollover for you directly. They'll actually work with you to pull the money out.
Okay. Okay. Thank you.
Mm-hmm.
We're going to take two more questions. The next one is from Amanda Paquette.
Excellent.
Hi, Amanda.
So I have a question. I'm 44 years old. I have my 401k, funded. I've got stocks. I'm in a really good place financially. I had quite a bit of, probably almost $16,000 of credit card debt. I'm a shopaholic. I now am down to about $2,000 that I owe. And my next thing that I really have to pay off is my student loans. I make monthly payments. I feel like, I owe about $20,000 in student loans. And this is like the one thing that has been hanging over my head. And I don't know, I want to start paying more. And I guess I don't know really where to start and how to get this balance down.
First of all, sorry about that. I didn't realize that the phone was on here. Okay, so let me just ask you a couple of questions about those student loans.
Sure.
Are they federal student loans or are they private student loans?
They're federal.
Okay, and are you in any sort of income-based repayment program, or are you just?
I am.
Okay.
I am. I've been making the minimum, but I make, I am.
Okay. And are you making a full retirement contribution?
Almost. No, I'm not. And I could probably put more.
So I would probably do that. And the thing about student loans is the interest rate is fairly low. And so if you are able to capture more matching dollars or shove more money into your retirement accounts, that's generally better than trying to supercharge and pay off your student loans. If you want to get out, at what point will you be done with them now?
My student loans?
Yeah.
Probably another 15 years.
So
if I continue to pay what I'm paying.
So you might want to add to what you're paying now. Look at what you could do, because what you just did in getting rid of $16,000 in credit card debt, that was really substantial. And that says to me that you've got extra money, you've got extra money muscle, and you have to take that and put it somewhere. So I would max out your retirement, but then I would throw the rest at the student loans. And I think what you'll see is that both continue to work in your favor.
Okay, yeah, I'm definitely not maxing out my retirement because I wanted to pay off the credit card debt.
I get it.
Hurts me. That was a lot of interest, and that was, one of my. But great, thanks for the advice.
Yeah, no problem.
Jean, one last question that came from when the folks registered, and I've recently heard you share this on one of your Her Money podcasts, and that was the recommended, I guess, formula or guidance on retirement savings and what you want to, what your goal, what's an optimal goal as you go from your 20s, 30s, etc., to your 60s. I want to think it might have been a Fidelity formula.
Yeah.
But you don't share that, because there were a few questions when folks registered about how do I know how much to save.
Sure. These are benchmarks, and I'll throw them out there. I don't want them to frighten anybody. And if you hear a benchmark and you think, I'm just not there yet, then the thing to do is just try to ratchet up your savings a little bit more, and you'll get there eventually. So by age 30, the goal is to have put away about 1 times your annual income for retirement. By age 40, 3 times. By age 50, 6 times. By age 60, 8 times. And by the time you actually retire, 10 times. Now, this money is meant to replace about 45% of your pre-retirement income in retirement. And so if you have a pension, and I know not everybody has a pension these days. In fact, very few people have pensions. But if you have one, and your pension is going to replace, say, 30% of your pre-retirement income, then you can lower those benchmarks substantially, because you only have to replace the other 15%. The saving 15% of your income on a consistent basis should get you to these benchmarks. That's how the formula was developed.
Thank you, Jean, for all of that and being with us tonight. And thank you to all of our members and friends that joined us here. We hope you found Jean's thoughts and remarks insightful and helpful. And want to let you know that if you do have questions about your personal finances, please, I'm sure you can reach out to Jean. I know she'd be welcome to hear from you. And feel free to reach out to us at Town and Country to share whatever questions you have, and we'll see how we might be able to help you reach your financial goals.